Meantime, Treasury yields were back on the rise. The spread between 2 and 10 years hitting a new 40-year low. So is this an early warning sign that the recent rally's best days are behind us? Well, we had a pretty decent rally, Dan. If you believe that that rally was pulled forward, then maybe that's the case. What do you think?
Yeah, maybe. And when you think about some of the other risk assets away from the stock market, I mean, yields have peaked, crude has peaked, the dollar has peaked, right? A lot of inflationary readings have peaked here. And I think that's what the stock market over the last month and a half has rallied into. We've seen this before in 2022. We kind of know the playbook. And now, as we think about the Fed downshifting of those rate hikes, we had 4 consecutive 75 basis point hikes. It seems pretty clear it's going to be 50 and maybe at least a 25 in January. And then we have all this quantitative tightening. So I guess the focus is we had that jobs number is a little better than expected. We have some other data that's trickling. It's a little better than expected. What the Fed Chair Powell said last Wednesday that caused a 4% rally in stocks that we've nearly given back most of it is that they're going to stay the course. Whatever the algos thought they read, Wednesday at 2:15, it was saying the thing that we all knew that we're going to say. So to me, to answer your question, yes, the rally has also pulled forward some excitement because things are likely to get a bit rockier in the economy over the next few months. And the stock market is likely to reflect that at some point. And it really won't bottom until, in my belief, estimates for 2023 S&P earnings have come down substantially. And that may not happen really until we get to the bulk of Q4 earnings in late January and February.
It also might not happen if there's continued momentum in the economy. And that's sort of what spooked the markets today, right? The services number came in better than expected, Julie. And all of a sudden it's like, oh, the Fed might be hawkish again. We might, have the Fed ramp up. And so, where do we stand here?
It's just a constant ongoing dance that we're going through with the Fed where we cannot figure out if bad news is good news bad news. It's about as easy to understand as any of my relationships, which is not very easy, as it turns out. But I think I think Dan is absolutely right. I think what really is going to be driving the market longer term is just when are we going to get these earnings revisions? Because if we look at numbers right now, they're just completely out of line with where sentiment is. And so until we get that, I don't think we can have a real proper bottom.
Karen.
So I'm looking, we're right back to where we were 2 p.m. on Wednesday. So that
Not
whole
very far.
mirage,
Yeah.
I guess. I think you're right. You brought up at the top of the show, the Santa Claus rally came really early this year. We had an enormous move from the bottom of October through early December. We were talking last week about it, like 14% or something like that. So this is not, it shouldn't be surprising at all. I still think this is just a tiny move down off of what was still a really huge, I'm not even fully sure why. But so I think, though, that the market isn't a monolith. We always talk about that. And some things, like today was a terrible day for any of the high-flying, the triple Qs and CRM, which we'll get to later. But anything that had a really high multiple today was a bad day for that. I don't think it should have had the run-up that it did have in the last few weeks. So I look at things that are low PE, and I don't think they're crazy. I think there's parts of the market that are actually viable here.
Yeah, like what?
Yeah.
Did you do any today?
I didn't do anything today, but I think something like, Foot Locker's one I've liked for a while. If I owned none, I would probably buy some right here.
Yeah. Jeff Mills, Dan brought up a good point in terms of the dollar, because that's, one reason why the markets have been able to levitate. The strength in the dollar abated. In fact, we've lost more than half of our gains for the year in just the past few weeks. And so, in terms of another reason for the markets to rally, I don't know if the dollar is going to come back a lot more off of that, but that was certainly one overhang over stocks and one reason why we needed to see estimates come down.
Yeah, there's no doubt about it. And the dollar's been at a key technical level for some time. And I think you're probably in the ballpark of it being oversold. But it's really been currency differentials that have been the driver. And I think that's sort of less supportive of the dollar right now. But then you also have safe haven flows. And I also think you have positioning. I think folks got very short euro. That has unwound some. So I think there's the potential for that trade to be put back on as we move into 2023. So I don't know. For me, the dollar almost seems like it becomes less of an issue. I don't think it's going to plummet from here. But I also don't know that the elements are in place for a massive rally here. What I do think, and I'll go back to what Dan said, is that earnings estimates do need to come down. And even if they don't, the risk reward is somewhat questionable here. So simple math, 2023 earnings at $2.23 a share. So that's projecting about 5% growth. In any type of recession scenario, that's too high. But let's assume that that's what we get. And let's put an 18 times multiple on that. Again, a multiple that is probably out of the question for the environment that I think we're going into. But let's be overly optimistic. That's what? 3% upside, maybe 5% upside from where we close today. So that's assuming we get that multiple. That's assuming that those earnings don't come down. So again, I just think the risk reward is not great right here. And with the catalyst for the market continuing to be the pivot narrative, I don't know that that's a catalyst for equities. I think maybe it's a better catalyst for the bond market than it's historically been for stocks.
A pivot meaning what? That once we reach peak, that the Fed backs off?
Yeah, I think when I hear pivot, I'm not talking about pause. I'm talking about an actual rate cut. So I think you could get a pause, and I think that they could stay at that level for quite some time. They've been very clear about that. But, I think the market has been so trained on this drug of easy monetary policy and rate cuts that everybody assumes as soon as the Fed cuts rates, all of a sudden we're going to be off to the races again. My guess is, again, that's a better catalyst for bonds. I don't think it's necessarily a great environment for risk on, because I think it's likely in response to something that's not terribly attractive in the overall economy.